Hello, everyone. My name is Nanette Abuhoff Jacobson. I'm a multi-asset strategist at Wellington Management. And joining me is Danny Cook, also a strategist at Wellington Management and co-author of our second quarter outlook for markets. It's complicated. We'll spend the next 15 minutes talking about our updated 2022 outlook from the multi-asset team. Well, markets have been quite challenging since the beginning of the year. We've been on a wild ride. From worrying about Omicron in December, we are now grappling with the economic and market implications of the war in Ukraine. That's what makes this current market environment so complicated. Instead of dealing with a single narrative, which was Omicron and the policy response, we are now dealing with multiple competing narratives, from geopolitics to inflation, growth, and the policy response. It makes 2021 comparatively look easy. So let's begin with our key points. I'll start with our key views and recommendations. First off, we do think that the war in Ukraine warrants a bit more of a defensive stance from an asset allocation standpoint. And that's because the tail risks have increased, both from a growth standpoint and an inflation standpoint. We are, though, still recommending being slightly overweight equities. And that's because we entered this conflict in a pretty good place in terms of the fundamentals. Particularly in the US, growth has been strong, and that's highlighted by the labor markets. So still feeling that having a slight overweight to equities is the right place to be. From a sector standpoint, the way we're expressing our defensive stance is regionally. We prefer US equities over European equities. We also like Japanese equities. And we favor developed market equities over emerging market equities. Now, US, as I said, it was starting from quite a strong place. Europe is the most exposed to the war in Ukraine, particularly on the energy side. And certainly the probability of recession has gone up there. And in Japan, we've got a much more accommodative stance from the central bank. Now, for emerging markets, the big region in emerging markets is China. And China is facing several challenges. One is their zero COVID policy, the weak real estate market, and also now some geopolitical risks as well. So a somewhat negative outlook on emerging markets. The third point is that our highest conviction remains in commodities. We are looking at all the different conflict scenarios, and short of a complete ceasefire and lifting of sanctions, all the other scenarios really do continue to involve sanctions on oil and gas of some sort. And certainly that threat of even more sanctions exists. So from our standpoint, the supply-demand imbalance in commodities remains, not just in oil, but actually a broader set of commodities. And therefore, we remain bullish on commodities. We also think that having some gold exposure is prudent in this environment where the growth inflation trade-offs have deteriorated somewhat. On fixed income, last point, we are moderately bearish on fixed income, and that is because we do feel rates are at risk of rising further in this high inflation environment. On the risk side, downside risks are clearly a surge in inflation that forces central banks to hike even more aggressively than they've indicated, or a further escalation in the Russia-Ukraine conflict. On the upside, that would include a Goldilocks scenario where the Fed tightens just the right amount and doesn't risk recession or inflation expectations becoming de-anchored. There's also a chance that policy in China loosens a lot and they unleash fiscal policy and ease central bank policy a great deal. And that would certainly present upside risk. both for emerging markets and the global cycle. So, Danny, can you share your thoughts about the fundamentals?
Absolutely. Thank you, Nanette. So we actually think that the global economy is fairly strong, and that's, I would note, despite really negative investor sentiment. So there's plenty of things to worry about, be it Ukraine or COVID in China or inflation. But ultimately, I would argue it's good to keep in mind that growth is pretty solid globally, as evidenced by this chart, and it should be a backdrop in which equities can outperform bonds.
Danny, certainly, and Chairman Powell has identified the labor markets as being particularly strong. But we also know that inflation has gone up. So, what do you say about real incomes, real disposable income in this environment?
That's a great question, Annette. And we feel that the key to the macro outlook from here is consumers. And we are sticking to the belief that real wages can turn positive, that consumers can dip into savings, and that they have ample access to credit. Now, one corollary of strong growth in a pretty hot labor market, as you mentioned, is higher wages, which can facilitate sticky inflation. So this chart is US focused, but it's a phenomenon that's true globally. And that is that wages are strong and potentially going up. So we are believers in inflation being sticky, but crucially, also that consumers are really well placed to handle it.
So, Danny, clearly energy prices hit $125 a barrel recently. It's come down. What do you think? I mean, in terms of our commodities overweight, should it just be in energy or allocated more broadly?
A lot of the attention and the focus has been on energy, but we're actually long commodities more broadly. So this table here shows that Russia and Ukraine account for big chunks of several commodities. So this really is not just an energy story. And our team has been overweight commodities for supply reasons for a while now, thanks to the great analysis from our commodities team. And we think that this conflict exacerbates those trends. And it's also a nice asset allocation play on inflation and protecting portfolios from higher inflation. Okay, so Nanette, I want to turn it back to you, as a lot of clients are asking if equities are cheap since returns year to date have been pretty lackluster. I know Japan is cheap, but what about emerging markets? And do you view that as an opportunity?
Right. So, as you can see on the slide, just to explain this to our viewers, we're showing percentiles over the past 20 years on a trailing price to book basis and Shiller PE ratio. And US is standing out as the most expensive region. But it's expensive for a reason, and that is because US, in this period of uncertainty, is considered a relative safe haven compared to other regions. Now, as you said, Japan, from a valuation perspective, that's definitely a plus for Japanese equities. In addition to that, as I said earlier, the central bank is certainly not as hawkish as the US central bank. And also, just corporate governance continues to improve for Japanese companies who have a ton of cash. So they've got great balance sheets, and many sectors have strong growth and revenue stories. Okay, for emerging markets, just like US is expensive for a reason, China is cheap for a reason. And just to go over those points, number one, China is a very large part of the emerging markets index. It's 35%. So that dominance means you really do have to have a view on China equities. So, what are the challenges? Number one, the zero COVID policy worked really well as we were dealing with the pandemic. But now that we're trying to come out of it, and now that Omicron is spreading, really raging through many parts of the country, it's becoming more and more difficult for that policy to be maintained. We are hearing from our China experts that something like 50 million people are in lockdown, which is affecting factories, manufacturing, and supply chains. So that's number one. Number two is the real estate market. We were hopeful that there'd be a recovery there, but the real estate market, which comprises something like a quarter of the economy, is still very weak. And we have not seen an upturn that gives us confidence that it's recovering sustainably. And then the third piece for China is that with the conflict between Russia and Ukraine, clients are putting a geopolitical risk premium on China, which is going to depend. They're trying to maintain neutrality, but obviously that is very unpredictable, difficult to analyze. So a risk premium that we think will persist for some time.
Nanette, since the US is so expensive, are there any sectors in there that you do prefer?
Yeah, I think that again, you've got to be much more judicious about the parts of the market in the US that you like. And I would bucket those areas into four categories. The first is companies or sectors that could benefit actually from the geopolitical situation and sanctions. And that would include defense companies. It would also include natural resource equities. I realize that for ESG reasons, clients may have restrictions on these, but because of our internal ratings, we certainly can distinguish between those companies that are improving their their ESG criteria. The second bucket would be quality equities. And here I'm focused on domestically oriented companies and service oriented companies. These are obviously more insulated from geopolitical uncertainty. And we do see service sectors recovering now that at least Omicron is behind us. The third group would be defensive companies. And there, I'm not talking about defense, but truly defensive companies. And here, parts of the healthcare market, utilities, also, we're finding some good value. And then finally, what are sectors that can thrive during higher inflation and higher rates? And here I would highlight REITs. So parts of the REITs market, especially those where rents are going up with high frequency on a monthly basis, so it can keep up with higher rates. That's one area. Another area would be just any big brand name companies that can maintain pricing power. And then finally, regional banks. Some banks have asset portfolios that are dominated by floating rate loans. So that's a subsector of financials that could do well. And then on the fixed income part of the market, I know you didn't ask me about that, but within fixed income, floating rate is where we're really focused.
Excellent. Makes sense to me. So, Nanette, as we wrap up, could you please summarize your views?
Sure. So we have this table which summarizes our asset allocation and sector views. And just as a reminder for our viewers, we have a 12-month outlook. And there are two levels of decision making that the multi-asset team makes. One is at a very high level, at the asset class level. And so on the top of this table, you can see that we are moderately overweight global equities versus an underweight in all of fixed income, both defensive fixed income and growth fixed income. We went over the reasons. Fixed income doesn't have a great outlook in an environment of higher rates and higher inflation. And that really applies to both government bond yields as well as to spreads, where we're seeing more of a positive correlation between rates and spreads. Commodities, as I said, we are bullish there, recommend an overweight, and really have the highest conviction there, not only because of the conflict in Ukraine, but also because of structural reasons that the supply-demand imbalance we think will persist. Now, the second level decisions are at the sector level. And so to express our more defensive stance, we are moderately overweight the US versus Europe and emerging markets. So an underweight to Europe, a overweight to Japan, and an underweight, as I said, to emerging markets. Then switching gears to fixed income, we are underweight defensive fixed income. Within that underweight, our tilts are to be moderately underweight European yields. Obviously, those yields remain among the lowest besides Japanese yields, but there we're more positive because of yield curve control, which we still think, even if it eases somewhat, we still think is a powerful limit to the upside in yields. On the growth fixed income side, again, we are underweight, and across the board, we're just expressing no particular tilts within spread sectors, but the one that I would say preferring floating rate structures that can keep pace with the rise in short-term interest rates. So I'll wrap up there. Thank you, Danny, for sharing your views. Thank you to our viewers for tuning in. And we will talk to you soon with our mid-year outlook. Thank you.
Thanks, Nanette.